Forex, or foreign exchange, the largest financial market in the world. Simply put, it's how individuals and businesses convert one currency to another. Trillions of dollars worth of Forex transactions take place every day. Unlike stocks or commodities, there's no central exchange. Instead, currencies are traded by a global network of banks, dealers and brokers, which means you can trade anytime, day or night, Monday to Friday. So how does it work? Well, Forex prices are quoted in pairs because, in effect, you are simultaneously buying one currency or selling another. Let's take euro-dollar as an example. On the left is the euro, known as the base currency. On the right, the dollar, or the quote currency. Now let's take the price is $1.3850. That means that €1 is currently worth $1.38.5. In reality, when trading Forex, you're always quoted two prices, the buy and the sell. The difference between the two is called the spread. Now you would buy this pair if you think the base currency will strengthen against the dollar. This is known as going long. Alternatively, you would sell the pair if you believe the euro will weaken. This is known as going short. Forex prices are influenced by a range of different factors, including interest rates, inflation, government policy, employment figures, and demand for imports and exports. And because of the sheer volume of traders and the amount of money exchanged, price movements can happen very quickly, making Forex not only the largest financial market in the world, but also the most volatile. To find out more about trading Forex, join IG Academy today. Learn at your own pace with our series of short, step-by-step courses and webinars on a wide range of trading topics.